Are you an S corporation owner? Then you need to watch out for some costly mistakes that could lead you to paying more in taxes than necessary. In today's video, I'll cover the top 5 tax mistakes S corp owners make and how to avoid them so you can keep more of your hard-earned money. Some of these might be a surprise to you, so stay tuned to make sure you're not leaving money on the table or even worse, getting in trouble with the IRS. If it's your first time watching, welcome. My name is Navi Maraj and I'm a CPA who helps entrepreneurs just like you save thousands of dollars in taxes. I share valuable insights right here on social media, and I also offer a comprehensive course at navimarajcpa.com which covers these strategies in more depth, but more on that later. Let's jump right into the common tax mistakes you should avoid as an S corporation owner. Mistake number 1, not using an accountable plan. One of the biggest mistakes I see S corp owners make is not implementing an accountable plan. But let me explain why this is so crucial. An accountable plan allows you to reimburse yourself for business expenses tax-free. If you don't have an accountable plan, then any reimbursements you receive from your S corporation are treated as income and are subject to income taxes. With a proper accountable plan in place, you can reimburse yourself for your business use percentage of your personal assets, and you don't have to count it as income. And yeah, you heard that right. Your business gets a tax deduction, and then you receive the reimbursement tax-free. This includes not just your home office expenses, but also the business use of your vehicle, your cell phone, internet service, and more. Think of it like this. If you use a portion of your home for business purposes, you can get reimbursed for things like, your mortgage interest, property taxes, homeowners insurance, cleaning service, repairs, the list goes on and on and on. All while not paying a thing in taxes when that money is reimbursed to you. And that same concept applies to the vehicle mileage or a portion of your phone bill or your internet service, all tax-free. It's one of those strategies that people don't talk about enough, but it could save you a ton of money by keeping your reimbursements tax-free. Chances are, if you're an S corp owner, you probably don't even know what an accountable plan is, and your accountant has never even brought it to your attention. Mistake number 2, not keeping track of basis and taking distributions in excess of basis. Another common mistake is not keeping track of your basis. So what is basis and why do you need to know and understand this? Your basis in an S corporation is essentially your investment in the business, what you've put in the business, plus any profits that you haven't distributed yet to yourself, minus any losses or distributions you haven't taken out. Let me kind of explain this for you. And let me ask you a question as well. Do you know your basis in your S corp right now? If not, you're at risk of paying taxes on distributions that exceed your basis. Here's kind of how it works. If you take distributions in excess of your basis, those distributions are considered a form of taxable income, specifically capital gains. This is what very few S corporation business owners understand. Let me explain this to you. Without tracking your basis, you could end up paying taxes you didn't even know about or let alone plan for, okay? One of the most common things I see is business owners racking up a bunch of expenses on a credit card. Now, while this decreases your profit, thus having you have to pay less income tax, it also lowers your basis. And the problem arises when the business owner doesn't pay down the credit card. They see the cash sitting in the business account and they take it as a distribution, not realizing they're going beyond their basis by doing so. This leads to distributions in excess of basis, which are then subject to either short-term or long-term capital gains taxes. If you're finding this information helpful, be sure to give this video a like, subscribe to the channel, and hit that notification bell so you don't miss out on any future content that can help you save big on your taxes. And leave a comment below. Let me know what you think about the importance of tracking your S corp basis, or did you even know about this, or did you even know what an accountable plan is? I'm curious to know so I can create more content for you. Let's go to mistake number 3. Mistake number 3 is not using proper bookkeeping software. Bookkeeping is a vital part of running a successful S corporation. A common mistake that many business owners make is relying solely on spreadsheets or having an incomplete bookkeeping system. You might think that tracking your income and expenses in a spreadsheet, essentially creating a profit and loss statement, is good enough, but that's only half the picture. I would argue less than half the picture. Without a proper balance sheet, you wouldn't know the full value of all your business assets, like whatever video equipment you may have purchased or a business vehicle. You see, it's not just about knowing what you own, but also understanding the book value of these assets, which includes accounting for the accumulated depreciation you've taken on that asset over time. And that's not all. A balance sheet is crucial for knowing your debts and your liabilities. It gives you the full picture of how much you owe, which is just as important as knowing what you own. Plus, without a balance sheet, you wouldn't know how much money you've contributed to your business over time. Imagine being a few years into running your business and being able to look at your balance sheet to say, I've personally invested $35,000 into the business. That is valuable information that you need to know. You simply won't be able to do that without having a proper balance sheet in place. Using bookkeeping software like QuickBooks helps you generate a full set of financial statements, not just your profit and loss, giving you the complete view you need to run your business effectively and avoid costly mistakes. Okay, let's move to mistake number 4. Mistake number 4 is electing S corporation status prematurely or even too late. Now let's talk about the timing of electing S corporation status, a decision that can either save you a lot in taxes or end up costing you more than you save. The sweet spot for considering S corp status is when your business is generating around $75,000 in profit. But here's the thing, there's a lot of misinformation out there. Some people might say that the right time to switch is when you're making $30,000 or $40,000 in profit, but this simply isn't true, and let me explain why. When you elect S corp status, you have an additional cost that you wouldn't have as a sole proprietor or LLC. These include increased tax preparation fees, payroll fees, and potentially more bookkeeping requirements. If your profit is below $75,000, these added costs can eat away at any tax saving you'd be getting by becoming an S corporation. Essentially, it's a wash. You're not actually saving any money in taxes, and you might even be paying more. So, when should you elect S corp status? Once your business hits that $75,000 profit mark, the savings you receive from reduced self-employment and taxes generally outweigh the additional cost of running the S corporation. But you need to evaluate this carefully and at the right time. I've covered this topic in more detail in a separate video, so if you want to dive deeper and see the specific numbers behind these calculations, make sure to check that out. Timing your S corp election properly can make all the difference in maximizing your tax savings. Last but certainly not least is one of the most common mistakes I see, not running payroll for yourself as an S corporation owner and instead taking all the business's profits out as distributions. It might sound tempting to take everything as a distribution and avoid paying payroll taxes. In fact, you probably don't even know you're doing it because your accountant hasn't even told you that this is not something you're supposed to do. But here's why it's a bad idea. As an S corp owner, you are required to pay yourself a reasonable salary for the work that you do. If you skip payroll and take all the profits as distributions, you're essentially bypassing Social Security and Medicare taxes, also known as FICA taxes, which, might seem like a good short-term win, but let me tell you, this is a red flag for the IRS. They could, likely reclassify a portion of those distributions as wages, and you could end up owing back payroll taxes, penalties, and interest. And trust me, that's a nasty place to be, and those taxes and those penalties and that interest is adding up quickly. For example, let me give you a case study here on this. Let's say your S corporation makes $100,000 in profit, right? And you decide to take all of that as a distribution without paying yourself a reasonable salary. If the IRS looks at this and determines that you should have paid yourself, say, a $60,000 salary, they can reclassify that amount as wages. Now, not only do you owe payroll taxes on that $60,000, but you'll also face potential penalties and interest for not complying in the first place. Remember, the key is to balance paying yourself a reasonable salary and take the remaining profits as distributions in which you don't have to pay any FICA taxes. This way, you stay compliant with the tax laws while still enjoying the benefits of minimizing FICA taxes on the distribution portion. As I mentioned earlier, I teach entrepreneurs just like you how to save thousands of dollars in taxes and avoid these mistakes because I'm teaching it to you properly from the start. Imagine joining students like Daniela, who saved over $30,000 in their first year, or Jeff, who's saving $25,000 annually, or even Valerie, another student who saved $10,000 in just the first year of implementing these strategies. And there are plenty of other case studies where students have saved $11,000, $6,000, $4,000 in their first year of business alone, right? The reason these results are possible is due to a unique 3-step process that I created that unlock your tax savings. But first, we need to start with building a strong foundation, understanding your business taxes and accounting fundamentals so you know exactly how your business should operate, right? You'll understand what is a profit and loss statement, what is a balance sheet, what are assets, liabilities, equities. Then you'll learn powerful tax strategies, and nothing is held back. You'll discover how to save thousands with an S corporation, how you remind your children to save taxes, contribute to retirement accounts for over $60,000 in a year, and then finally, you'll implement the strategies with me, step by step, with me by your side using QuickBooks, ensuring that you save every dollar possible. And here's the best part: most students complete the course in just a few weeks, so you could be on your way to massive tax savings in a matter of a month. Whether you're a brand new entrepreneur or running a business with over $1 million in revenue, the course is designed to help you. And plus, I offer a 30-day money-back guarantee, so there's no questions asked. All the risk is on me. All right. So if you're ready to start saving thousands, visit my website, it's navimarajcpa.com, or click on the link in the description below to learn more and preview the course content. So if you learned something in this video, subscribe to my channel and click on the notification bell so you'll be alerted when the next one is released. Or if you can't wait and you want to learn more right now, click right here to watch another one of my valuable videos. And in this one, I talk about sort of the S corporation profit line so you can determine what it might make sense for you to enact the S corp strategy in your business. I'll see you there or in the course.